McDonald's and Coca-Cola
recently
company.
made a high-stakes, multi-million-dollar marketing pivot that has sparked intense debate across the advertising industry. In an effort to leverage automated generation and optimize production budgets, these global giants rolled out ambitious AI-driven campaigns. Instead of praise, they met significant consumer pushback and brand sentiment challenges that forced them to carefully reevaluate their digital strategies.
Before go ahead, please like the video, subscribe the channel and share with your friends.
But this isn't just a story about technical limitations. This is a look inside the modern corporate push to automate creative workflows and the friction that occurs when technology meets public expectation. Here is the real analysis behind the corporate AI misstep. To understand how two of the most sophisticated marketing teams on Earth arrived at this point, we have to look at the economic reality behind global commercial production. A traditional, cinematic holiday ad campaign typically requires months of development, a large crew of creative specialists, and significant capital. But when generative video models took a massive leap forward, enterprise executives saw a major operational shortcut. On paper, the efficiency pitch was incredibly compelling. Instead of managing massive production sets, digital operators could utilize text prompts to generate multiple creative assets in a fraction of the time, shrinking traditional project timelines. The boardroom goal was clear: scalable content, optimized messaging, and reduced overhead. Major brands rushed to be market pioneers. However, they underestimated a fundamental rule of consumer psychology. Audiences build relationships with authentic human stories, not just mathematical outputs. The structural friction in this strategy became highly visible during the high-stakes holiday retail window. Coca-Cola released an automated remake of its classic winter commercial, where the original campaign relied on tangible assets, practical lighting, and genuine emotional warmth. The new iteration was met with criticism for its hyper-stylized, sterile aesthetic. Even as creative studios shifted strategies in subsequent campaigns, pivoting away from human expressions toward animated subjects to work around technical limitations, consumer scrutiny remained high. Audiences quickly highlighted unnatural physics and synthetic visual anomalies. Meanwhile, McDonald's regional branch faced unique challenges with a winter campaign that leaned into a highly stylized, chaotic seasonal narrative. When paired with experimental software rendering and unusual color palettes, public feedback was highly critical. To protect brand consistency, the digital assets were quickly adjusted and updated across major video platforms. This is where the long-term financial metrics reveal a massive risk. While initial automation can drastically lower upfront development costs, the broader impact on brand equity must be considered. Independent industry data revealed that positive consumer engagement metrics faced downward pressure following these rollouts, while critical discussion spiked online. In modern commerce, sacrificing long-term audience trust for immediate operational speed can become an expensive trade-off. Furthermore, industry data exposed the operational bottleneck of the fully automated creative process. Creative production teams noted that staff still spent countless hours generating tens of thousands of asset iterations just to compile less than a minute of polished content. When a system requires that much human oversight and technical troubleshooting to match baseline commercial standards, the true cost efficiency becomes highly debatable. Moving forward, artificial intelligence will undoubtedly remain a core tool in the marketing workspace. However, this cross-industry pushback proves that automation cannot easily replace emotional resonance, shared nostalgia, or genuine human storytelling. When the cost of operational efficiency is the erosion of consumer trust, the business model simply falls short. If you found this corporate strategy analysis valuable, please consider subscribing and liking the video. Let us know your perspective on automation in the comments below, and we will see you in the next analysis.